Over the years, Bitcoin has been called many things: a bubble, a hedge, a tech stock in disguise, but what if we've been missing the bigger picture? Right now, something is quietly unfolding beneath the surface of the financial system. And the last time this happened, Bitcoin surged 600% in under 1 year. And now, analysts are watching closely, with some predicting Bitcoin could easily reach $150,000 by year's end, assuming this trend continues. But few are talking about why. In this video, we'll break down what's really going on with Bitcoin and why this overlooked indicator could be the key to understanding where Bitcoin is headed next. Let's dive in. You see, over the past decade, Bitcoin has followed tech stocks like a shadow. When the Nasdaq went up, Bitcoin went up more. When it dropped, Bitcoin cratered. But this time is different. In April 2025, markets were rocked by the geopolitical shock, specifically President Trump's aggressive tariff announcements. Stocks tanked, the S&P dropped, and the Nasdaq got crushed, and yet Bitcoin rallied. That shouldn't happen unless something fundamental has changed, and it has. You see, this is what analysts call a decoupling, when an asset stops following the crowd and starts moving to its own rhythm. For the first time in its history, Bitcoin may be working on breaking free and decoupling from most, but maybe not all. But firstly, this decoupling matters for one simple reason: diversification. You see, every serious investor looks for non-correlated assets, ones that don't all sink when the ship goes down. Historically, Bitcoin wasn't that. It moved like a high volatility tech stock. But now, Bitcoin is starting to act like gold. When the global economy wobbles from tariffs to currency crises to banking scares, investors look for safe havens. If Bitcoin keeps behaving independently, it might finally mature into what early adopters always said it could be: a true hedge against systemic risk. This isn't just a theory. BlackRock has run the numbers. After major global shocks, whether it's the Ukraine war, the Silicon Valley bank collapse, or the recent yen crisis, Bitcoin consistently outperformed equities and often even gold. Why is this? Because Bitcoin isn't tied to borders, banks, or political baggage. It exists outside the traditional financial system, and in a world of growing instability, that's its greatest strength. We're seeing institutions recognize that. More importantly, we're seeing governments take notice. Just this week at the Bitcoin conference in Las Vegas, the New York City mayor stated that they plan to issue their own Bit Bond, the first municipal blockchain bond in the US. Florida just this week passed legislation making gold and silver legal tender. Yeah, you heard that right. And Bitcoin is likely to be next. Aside from that, Bitcoin is quietly gaining ground in that conversation, where states like Wyoming and Texas are exploring state-level Bitcoin reserves as part of their long-term fiscal strategies. Ohio, Missouri, and New Hampshire have all floated pro-Bitcoin legislation in recent months. Even President JD Vance at the Bitcoin conference recently stated that 100 million Americans will soon hold Bitcoin. Maybe this was a general statement to hype up the crowd, or better yet, maybe it's foreshadowing for something to come. But ultimately, this is echoing a broader shift among policymakers towards integrating digital assets into government planning, but more specifically, Bitcoin. But here's where the story goes deeper. If you really want to know what's next for Bitcoin, ignore the price chart, ignore the headlines, watch M2, the money supply. M2 is a measure of all the liquid money sloshing around the economy: checking accounts, savings, cash, and near cash investments. It tells us how much spending power is available in the system. And right now, M2 is spiking like crazy. After contracting through 2022 and 2023 due to aggressive Fed tightening, M2 is up over 4% year to date in 2025 and climbing. But before we dive into what this M2 shift could mean for Bitcoin's future price later this year, let's discuss something that's also been reacting to this M2 shift: silver and gold. But here's the twist. What if I told you that in 2025 you could actually earn passive income from gold and silver and also spend them like cash? And I'm not talking about just in Florida. I know that sounds improbable. That's exactly what our channel sponsor Kinesis Money has made a reality. And right now they are offering DataDash subscribers half an ounce of free silver when you sign up with the unique promo code DataDash. So let's be honest for a sec. Precious metals are incredible long-term stores of value, but in the modern world, they've become a major pain in the ass. You can't exactly use gold coins at the gas station. Well, aside from Florida soon, but you get the idea. You can't stake for yield, and holding physical metal can be a hassle. You got storage fees, security risks, zero liquidity, but luckily, Kinesis flips the entire script by creating a digital ecosystem where gold, KAU, and silver, KAG, are fully backed by vaulted metals and made as usable as crypto. You can trade them, earn with them, and soon even spend with them directly with a debit card. So even if you're not in Florida, you can partake in using gold and silver as tender. Now I gotta say, there's not many products that really surprise me in the industry anymore, but I've been using Kinesis for a few months now, and what really has me hooked is their multi-yield system. This isn't some DeFi copy and paste. You actually earn income just for holding your metals, participating in the ecosystem, and even referring others. Here's a quick breakdown of the 5 yield streams, and then we'll get back into the video. First, we have the holders yield, which is simply passive income for just holding your gold and silver. Then there's the minters yield, where you earn when others transact with metals you've minted. Next, we have the velocity yield, which is earned for any trades, swaps, or purchases made on the platform. Then there's the referrer yield, where every trade your referral makes, 7.5% of their transaction fees go to you. And lastly, and the most promising, the KVT yield, where users can receive a global revenue share for holding the KVT token based on platform volume. While just one of these yields alone are nothing revolutionary, combine them and you are looking at a way to earn high yield off of the real world assets backed by real world value. So if you're looking for a modern way to own gold and silver and you like the idea of earning yield, spending metals, and hedging inflation, Kinesis might be one of the best kept secrets out there. And remember, if you want half an ounce of free silver, use the unique promo code DataDash when you sign up with the link in the description. Okay, now historically, when M2 rises, Bitcoin follows, not instantly, but with a 6 to 9 month lag. In 2020, the Fed unleashed trillions of dollars. M2 surged. 6 months later, Bitcoin exploded from $10,000 to $69,000. In 2022, the Fed reversed course. M2 shrank, Bitcoin fell under 20K. And in 2025, M2 is expanding again. If the pattern holds, Bitcoin could be gearing up for a major breakout by Q3 or Q4 of this year. Crypto Slate recently published a detailed breakdown of this trend. Their data shows that Bitcoin's recent breakout above $100,000 aligns almost perfectly with the lagged M2 increase from 3 months prior. In other words, Bitcoin may already be reacting to this monetary shift. And if this pattern holds true, just like it did in 2020 and 2021, we could be witnessing the opening stages of Bitcoin's next exponential move. The projection, $150,000 by Q4 2025. This isn't just plausible, it may already be in motion. But why does this happen? Well, because Bitcoin is a sponge for excess liquidity. It has a fixed supply, so when more dollars chase the same number of coins, price goes up. Bitcoin also has no yield, meaning its value is largely driven by monetary confidence. And since it's global and borderless, it reacts faster than traditional assets when money supply increases. This is why Bitcoin has begun outperforming traditional hedges. Bonds are lagging, gold is slow, real estate is liquid. But Bitcoin, it trades 24/7 and reacts in real time. If M2 keeps rising as it often does in election years, Bitcoin may reach much higher highs well before the end of the year. But here's another part most people missed. In early 2025, the Federal Reserve quietly rolled back several key barriers that made it difficult for banks to engage with digital assets. Now, banks no longer need special permission to offer crypto services. that is a game changer. It means more on-ramps for consumers, more demand for institutions, and the real possibility that Bitcoin becomes a default option in everyday banking. Imagine your credit union letting you buy, sell, and hold Bitcoin like any other asset, safely, securely, and insured. That future is coming faster than most realize. At the same time, governments are moving. New York's BIT bond might become a model for blockchain-backed public finance. Florida's alternative currency law could expand into crypto. Texas is tying Bitcoin into its energy grid, and multiple states are now considering holding Bitcoin on their balance sheets, not as speculation, but as protection. Put all of this together and you have a perfect storm, a historic decoupling from equities, a rising M2 money supply, a regulatory green light from the Fed, institutional money knocking on the door, and state-level governments treating Bitcoin as part of serious fiscal planning. Bitcoin is still volatile, yes, and nothing in the market is guaranteed, but what we're seeing right now is truly historic and will be looked at 30 years from now. Bitcoin may no longer be a speculative tech gamble. It may be maturing into something far more serious, a hedge, a reserve, a new layer of global monetary system. Watch the money supply, watch the policy shift, and most of all, watch Bitcoin, because if this trend continues in 2025, this might just go down as the year Bitcoin grew up.